Hi investors, welcome to the monthly interaction again from Canara Robeco. Let us discuss three or four broader aspects as far as markets are concerned. Let us start with the global aspects because there have been two or three key events that have happened there which are actually creating some volatility in market. How are we seeing them? Second is domestic macro, third is earnings, and lastly valuations. These are the four aspects that we will discuss over next 10-15 minutes. Let us start with the global piece. Everybody has been waiting for the interest rate cuts, and I think finally we are closer to that. The incremental data points on the labor force side have started turning weak. The unemployment data in US actually came as a significant negative surprise in last week, and that has led to actually the kind of correction that you have seen in the 10-year G-Sec in US. So that's the clearly first event whereby in US finally the growth seems to be receding faster. It is showing up in the labor force data, which is the unemployment rate, and as a consequence everybody is expecting now that probably even before September we'll get the interest rate cuts. We have been actually votary of this thought process that growth will slow down slowly and then very rapidly, and that will be the outcome most likely for the interest rates as well. So we expect that the way current data points are, if there is no negative positive surprises on growth side, you will get anywhere between 250 to 100 basis point of interest rate cuts over next 6 to 9 months. That's the global side. Now, what does it mean? It also means that the in a way incrementally there are significant growth headwinds from particularly US side. So that's one. Second, coming to the geopolitics, it looks like the geopolitics is actually getting complicated, and it can flare up at any point in time. And this is an outcome of what Israel did, particularly going and killing the chief of Hamas in Tehran. While on the face of it, it doesn't look like it looks like one more incidents. But frankly, personally, I'm really worried about the kind of instances that are happening. It clearly actually leading us to probably a point where a geopolitical escalation in Middle East is a relatively far higher probability event than lower. So that was the second event on global side, which creates in a way disruption, which can create commodity energy related challenges, and at the same time it can lead to a flare up, which can be sizable flare up if it were to actually happen between Israel and Iran. Coming to the third aspect, that was additional data point that we got in last few weeks, is Japan finally decided to actually increase the interest rates. While the incremental interest rates, when we look at it on an absolute basis, is small, but what it means is it actually reduces the attractiveness of the yen carry trade that was happening, and that has actually rattled the market, as you can see over last few days, whereby the Japanese market has corrected by more than 20%. Even the other markets have corrected anywhere between 5 to 15%. What is our take on that? Our take clearly is that there is limited scope for Japanese central bank to increase the interest rates. So we see it more as a technical event rather than something that can structurally change the global paradigm, as some of the people are calling out. So those are the three key events that have happened on global side. The US seems to be clearly moderating on growth. Inflation data is coming out incrementally good, which means you are going to see interest rate cuts at a faster pace than what we were anticipating. And frankly, it's not such a great news, because as a first leg, it also means that you're going to have growth headwinds globally. Okay, that's a first. Second, as I said, basically you continue to have challenges on the geopolitical side, and to add to that, you had yesterday Bangladesh issues, which actually have taken the geopolitical challenges on our to our borders as well. And lastly, we see Japanese interest rate increases and the reversal of yen carry trade more as a technical and knee-jerk reaction rather than anything fundamental. So those are the three key global aspects. Moving on to the domestic side, as far as last month is concerned, there is no incremental negative surprises that have come on any of the macro data points. The macros continues to be good. The budget was neutralish. The budget continues on the path of fiscal consolidation. The monsoons have been good. Of course, there was some expectation as far as budget is concerned in terms of increases on the rural stroke consumption side, which has not materialized to the extent that people were expecting. But as far as most of the macro data points are concerned and budget is concerned, I think it was either neutralish or positive, right from inflation data to CAT data to fiscal deficit that is projected to the growth numbers. Largely, the macro remains as good as it has ever been in India. Also, more than the just statistical macroeconomic data point, the balance sheets remain in good shape, which we have been repeating virtually in every conversation that we had. You continue to have very good balance sheets on the corporate side. You continue to have very good balance sheets on the banking side, and now the government is also actually kind of trying to get its balance sheet in a better shape through the continuous fiscal consolidation, whereby they are saying that next year they'll go to probably 4.5 and below. All of these things tell you that the macro environment from a balance sheet perspective remains good. Yes, the challenge to our mind or the hiccup to our mind is on the income growth side. In economy, probably the income growths are not so strong, and that's reflecting in the P&L, that's reflecting in the corporate earnings growth incrementally. And that's the third point that we are going to discuss. How are the corporate earnings shaping up? What is our assessment of corporate earnings? I think this is the data point where, in the context of where the valuations are in market, we are little cautious, we are little circumspect. Clearly, financial year 24 was unusually high earnings growth year because you got probably a 10% revenue growth, but you got a 35% bottom line growth, predominantly because of the commodity corrections and margin expansion. That is largely absent in financial year 25. Your margins in most of the commodity user segments are at and near the peaks. So what you have to rely more and more this year is on volume growth, and that has been little elusive in market, as I alluded to. That balance sheets is not a challenge, but the income growth is a challenge, and so demand is a challenge, and that's why volumes is a little bit of a challenge, and that reflects in the kind of top line growth that you are seeing in the economy. And so even when you look at the quarterly results that are underway, clearly the quarterly results have been at best neutral to negative. There is nothing significantly positive against the expectation that is to write home. As far as all the results that have come in, clearly the earnings growth is in single digit for this quarter. Of course, it was expected to that extent. Even if you adjust for some of the one-offs, it's probably low double digit, and that's what our expectation is, that for financial year 25 you are going to get a probably most likely you are going to be based on the consensus, the earnings growth is likely to be anywhere between 10, 11, 12% to 14%, 15% max, which is going to be a significant or sizable moderation from where you were in financial year 25. So that's the earnings piece. Near term, little bit of a caution, little bit of a moderation because of the lack of volume growth against the margin expansion that was available last year. That's where we are in terms of the earnings. Having said that, financial year 25 still looks like it will be anywhere between 10 to 15% earnings growth for different parts of the market. Financial year 26, based on the consensus number, is again 12 to 14% earnings growth. So that's the earnings piece, that your earnings growth CAGR will be somewhere in between 10-11% to 15% depending on the part of the market that you are discussing. That's the earnings piece largely. Where are earnings very healthy? Clearly earnings still are relatively healthy on the domestic cyclical side. So non-banking financials, market infrastructure plays in financials, industrials, auto, real estate, hotels, hospitals, telecom, and pharma. These are the spaces where either the earnings are resilient or they are trending up, whereas you have spaces where the earnings are neutralish but they are bottoming out. For example, in FMCG the earnings are bottoming out, in IT the earnings are bottoming out, in the chemicals the earnings are bottoming out. So that's where earnings are domestically. Still on the domestic cyclical side, the earnings are superior. The challenge there is the valuations are too fairly rich, except probably the spaces like telecom and pharma. Rest of the spaces on domestic cyclical side are fairly rich in terms of valuation from a near term context, whereas on the other side you have sectors where the earnings have bottomed, be it IT, FMCG, chemicals and some of the other spaces, but the earnings upgrade cycle is still not underway, and so incremental re-rating will be a function of how the earnings pan out. So that's the dichotomy in which you are stuck, where the part of the market where the earnings are very strong, the valuations are rich, the part of the market where the valuations are uh, relative basis attractive, or earnings upgrade cycle is missing at the market. So that's where we are in terms of earnings. Having actually given this picture, which is a picture from financial year 25 perspective, we still broadly think that one has to be constructive on Indian equities from a medium term perspective. And the fundamental reason behind that, again, we have alluded in some of our conversations, is that typically your earnings cycle is a function of business cycle, is a function of underlying economic cycle. And when you look at India, our hypothesis is that you are in a business cycle. Typically, you get a cycle where you start with the government capex or PSU capex, which is the leg that we have seen over last 2.5 years. Then you go into private capex, then you go into full-fledged real estate cycle, and then you go into mass consumption. And that is the pattern. We believe that this cycle will also eventually play out. Of course, the direction is very clear, the pace is not very clear, but we have just seen the basically public capex. We are yet to see full-fledged private capex, we are yet to see full-fledged real estate cycle. And that's where our thesis still remains, that as these balance sheets keep expanding, because balance sheets are pristine across the board, be it corporates or banks or the top 10-15 crore people in the country in terms of households, the balance sheets are extremely pristine, and so they will expand the balance sheets. And when the economy, key stakeholders in the economy expand balance sheet, typically you get a healthy earnings growth and a good economic cycle, credit growth cycle, business cycle. And that's what we are actually expecting to happen over next 3 years. And so people should actually take a more medium term view, should moderate their return expectation when they look at equity market. The valuations in most part of the markets are rich, so your return expectation should be more aligned to the earnings rollovers or earnings CAGR rather than any re-rating expectation. So that's how broadly we are looking at market. In terms of portfolio construct, we are still predominantly overweight domestic cyclicals, non-banking financials, market infrastructure plays, hotels, hospitals, industrials, real estate, cement, pharma and telecom. These are the spaces where the portfolios are either neutral or overweight on, whereas there are spaces where the portfolios are underweight but have been gradually been adding to the position. So it's likely to be a year where actually you will have gradual and significant shift over a period of time in terms of portfolio, where probably some part of the domestic cyclicals will eventually be replaced by the either global cyclicals or the consumption part of the economy, as and when the earnings actually traction shows up in those parts of the market. So that's how the portfolios are from a overweight underweight perspective. Auto is overweight, industrials is neutral to overweight, cement is overweight, hotels, hospitals, pharma and telecom, these are the overweight sectors. The underweight sectors still net are to some degree IT is underweight, to some degree FMCG is underweight. While we have added to positions in this sector, they are still underweight. Metals and energy are the two largest underweights in the portfolios. Broadly, that's what all we have to talk for last month from equity market perspective. Thank you.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.